You know what, you find a company that just seems to do everything right? I mean, a business so dominant, so well run, and so profitable, it feels, well, almost perfect. Today, we're going to look at one of those companies. But, and this is the big but, we're also going to tackle the single most important question that always has to follow. Is it a good investment?
Okay, so let's really get into this. It sounds like a simple question, right? But honestly, it's the absolute heart of smart investing. You can totally fall in love with a fantastic business, but if you pay too much for it, guess what? You can still lose money. The difference between a great company and a great investment, it often boils down to just one word: price.
So we're going to use a real-world case study here, a company that is, for all intents and purposes, an absolute fortress in its industry. We're going to look at its crazy competitive advantages, its brilliant management, and its just stunning financial performance.
And then, just when you're ready to go all in, we're going to pump the brakes hard. Because after all that incredible news, we're going to uncover the one critical factor that turns this story from a simple buy it now into a much, much more complicated decision. All right, let's do this.
So the company we're talking about today is Cadence Design Systems. Now, these guys create the essential, mission-critical software that basically every major tech company, we're talking Apple, NVIDIA, you name it, uses to design the computer chips in our phones, our cars, our computers, everything. And their business? It's protected by a competitive moat that is unbelievably wide and deep.
What's so powerful here is how these barriers all lock together and reinforce each other. I mean, engineers spend years learning the software, which creates massive switching costs. The tools themselves lock in entire generations of chip designs. Then you've got this huge network effect where designers and manufacturers all have to be on the same platform. And the kicker? Cadence plows nearly 40% of its revenue right back into R&D. It's almost impossible for a competitor to even think about catching up.
And this number, wow. This just perfectly illustrates the power of that moat. A 90% gross margin is, well, it's staggering. It means for every single dollar of software they sell, 90 cents is gross profit. That is just pure, unadulterated pricing power. It tells you their customers need this stuff, and they have basically no other options.
Okay, so we've established it's a fortress of a business. But what about the people in charge? You know, a great moat is one thing, but you really need a smart king inside the castle. And the management team at Cadence has proven to be exceptionally good at making smart, rational decisions with the company's cash.
You can see their whole strategy right here. Instead of just handing out a dividend, they pour that money back into the business to make that fortress even stronger. Like we said, almost 40% goes right back into R&D. They also make really smart acquisitions and consistently buy back their own stock, which makes every share that's left more valuable. It is a total masterclass in thinking about the long term.
This quote from the analysis just hits the nail on the head. It means that every dollar they've kept in the company, instead of paying out, has been reinvested to create more than $1 of value for shareholders. That is the absolute gold standard. It's exactly what you want to see from a management team.
All right, so we've got a dominant business and brilliant management. Let's see how that actually translates to the bottom line. This is where the story gets even more impressive because the financial results here are, well, they're just outstanding. Just take a look at this. Return on equity, or ROE, basically shows how good a company is at turning shareholder money into actual profits. A good ROE is, maybe 15–20%. Cadence's isn't just high, it's accelerating into truly elite territory, now hitting over 70%. That level of capital efficiency is just incredible.
And we're not talking about some fuzzy accounting metric. We're talking about real, hard cash. Free cash flow. That's the money that's left over after running the whole business. It's what an owner could theoretically just stick in their pocket. And in just 4 years, Cadence has doubled it. From about $700 million to $1.4 billion. The company is an absolute cash machine.
So, at this point, you're probably thinking, this is it. This is the one. It's the perfect company. And you know what? You're not wrong. The business itself is phenomenal. But now we have to pivot and ask the single most important question for any investor.
So here it is. We know it's a great business. We've established that. But what is it worth? How do we actually put a dollar figure on this amazing company to know if today's price is a good deal, a fair deal, or a really, really terrible one?
Now, this valuation process, it's not some kind of magic. The idea is pretty straightforward. You project out all the cash the business is likely to generate in the future, and then you discount all those future dollars back to what they'd be worth in your pocket today. And that gives you something we call intrinsic value, a solid estimate of the company's true worth on a per-share basis.
And here it is, the climax of our whole story.
Based on a really detailed analysis of its future cash flows, the intrinsic value of Cadence is calculated to be somewhere between $175 and $190 a share. But the market right now is charging over $300 for it. That is a massive, massive disconnect between the value and the price.
Which brings us right to that classic piece of investment wisdom. Price is what you pay, value is what you get. We've definitely established that the value here is an incredible world-class company, but the price you have to pay today is significantly higher. So how on earth is an investor supposed to think about this?
The key concept here, the one that can save you, is the margin of safety. You always want to buy a great business for less than it's worth. That discount is your buffer. It protects you if your calculations are a bit off, or if the future isn't quite as sunny as you predicted. By trading at a 62 to 76% premium to its value, Cadence offers what you might call a negative margin of safety. There is zero buffer.
So the final verdict from this analysis is pretty clear-cut. For a new investor looking to buy in today, the price is just too risky. The recommendation is to avoid. But for someone who already owns it and hopefully bought it much, much cheaper, the sheer quality of the business makes it a hold. You don't just rush to sell a company this good.
And that really leaves us with a final question for you to think about. It is so easy to fall in love with a great story, a dominant product, a brilliant team. We all do it. But the difference between being a fan and being a successful investor is that an investor always checks the price tag.